Hey guys, John Pauly here, Actionable Intelligence. Today is Saturday, December 22nd, 2018, and this is the weekly market update. Okay, so first things first, I want to talk about market volatility and what's been going on in the market and why this is an excellent opportunity to put into practice what we've been talking about in the past. One of the things that I'm a big fan of is volatility. Why? Because it gives me the opportunity to buy things that I have a high conviction in at a cheap price. So here, for example, is a chart of Uranium Participation Corp. For those of you that may not know, this is a vehicle that purchases physical uranium and stores it in drums, bonded drums, or in a bonded warehouse. So it's basically you're buying physical uranium. So we don't have to go over the uranium thesis. Everybody that listens to this video series or these podcasts, whatever you want to call it, knows what is going on with uranium, why we have a high conviction of why it's going higher over the next couple of years. So here we have a situation where the overall market is been very bearish over the last several months and has driven down everything. So everything's just being thrown out out the window as like it's useless or going down. And here we have physical uranium that you can buy on the stock market basically at about a 10% discount to its value. So you're basically being able here to buy $1 worth of uranium for 90 cents. If you're a uranium investor and you want to purchase physical uranium, which I think everybody should do as a cornerstone to their uranium portfolio, why wouldn't you look at this as a gift horse? Anything can happen in these markets over days, weeks, or months, but in the end, fundamentals will rule out. It's just that simple. In the end, fundamentals will have their day. And we've seen the uranium price move higher in 2018. We've seen the things that we've been waiting for, i.e. production cuts and increased demand take hold. We know what's going to happen. Barring a Fukushima or Chernobyl event, uranium prices are going substantially higher over the next couple of years. It's just that a fact. It's going to happen. So when you're presented with the opportunity to buy, and I'm not even talking about any of the juniors or Cameco or anything like that. I'm just talking about physical uranium here. You're able to purchase it at a discount to net asset value. It's just like walking over to the corner. It's like walking down the street and finding a $100 bill in the gutter. You just pick it up. I mean, this is just easy. Just walk over to the corner and pick the money up. How hard is that? So I think people get all nervous. They get all wound up watching the daily news, watching CNBC, Bloomberg, the rest of this nonsense, getting on zero hedge. That's, it's like doom porn. Every day is the end of the world on zero hedge. But like I said, barring a nuclear accident at a plant, uranium's going higher. It's that simple. I don't know the time frame. I know it's going higher. So being able to buy things at a discount when I know something is how it's going to shake out, or as Rick Rule says, a when event, not an if event, then you have to be a buyer. And that's how the real wealth is created. That's how the big money is created, guys. It's just that simple. And if you're unwilling to do that, if you're chewing your fingernails going, well, we're going to have a global recession and power production. No, this is going higher. There could be bouts of when prices go down. If we had a 30% crash in the stock market on Monday or next week, and this thing dropped to like under $4, I would be like mortgaging the house. I'd be taking cash advances on credit cards. I mean, I'm not saying that to be funny. That's what I would do. I would be in there buying. I mean, you're getting to situations where they're once in a lifetime or once every 20-year events. And you have to be a buyer. You have to be in there buying if you have the conviction. If you understand the research, if you've done it and you're convinced and you cannot be dissuaded by any of the bearish arguments, then you have to be a buyer. You have to have that conviction. So that kind of spills over into oil. Now, this is very touchy. I mean, we've lost a lot of money here. I got double clutched by Trump. I'm not blaming him. I mean, things happen in the market and we have setbacks, but it's the same thing. Does anybody think that a almost 50% decline in the oil price is justified based on all of a sudden everybody on Wall Street and everybody in the banking, everybody, all the economists finally said, okay, we're going to have a global recession next year, and oil demand is going to drop sufficient to, warrant a 70% decline in some of these stock prices. I mean, I don't buy it. I'm sorry. I mean, I've done the research. I know what oil demand is in Asia, in emerging markets and frontier markets. I know when people enter the middle class, their propensity to spend, and that once somebody buys a car, they don't park it in the garage, they actually drive the thing. And I can do the math. It's spreadsheet math, guys. Spreadsheet 101. 1 to 1.5 million barrels a day of increased demand every year. Add that to 4, 5, 6% depletion in oil fields I'm talking about total, not just shale, not just the North Sea, everything put together, 4, 5, 6%, whatever number you want to put on it in a spreadsheet, means you got to find and bring on new production every year to meet demand plus overcome depletion of basically anywhere from 5.5 to 7 million barrels a day. That's a new Iraq found and brought online every year. That takes hundreds of billions of dollars of investment every single year. So in the interim, we haven't been doing that. We have not been doing that for many years, and that's why we've been having these oil spikes. Now, this short-term drop has been a confluence of events like, the Trump double cross of Saudi and OPEC on the Iran sanctions when he gave all the waivers at the last minute after they've been overproducing for months to get ready for it. That's changed now. There's been a cut in production, and they're backing down. And I don't think that they're going to go along with any type of sanction thing again. Shame on you, or you bit once, shame on you. Bit twice, shame on me. So I don't see that happening again. We had a more intensive refinery turnaround season in the United States. There were more refineries in turnaround than normally, but by more units offline than is normal, by a factor of like 30 or 40%. So that cut refinery runs. So stuff, product oil was backing up in storage. Another thing people forget is Venezuelan oil supply is still collapsing. So the fundamentals are still in place. The money's not being spent to overcome the depletion and to meet the new demand. Yes, if we have a global recession, which we may be entering a slowdown, as I pointed out last week, but that doesn't mean we're going to have a 2008 general financial crisis and see oil demand actually shrink. And even during the 2008 crisis, oil demand was only down, a little bit. It wasn't down massively and didn't recover. When oil demand actually goes down, guess what happens? More people start using oil when it becomes cheap. So you've got that working for you too. So, what we've seen is fund liquidations, the Trump double cross, a lot of confluence of events that has scared people and changed sentiment to be very, very negative towards oil and oil stocks. I can't predict the future. I don't know what's going to happen. But I suspect that when you see these levels of negative sentiment, when you see these levels of things being oversold, that they tend to recover. I've said this before. I said it on Twitter this week. But my two main themes for investing, and it applies to uranium and oil and all the things that I speculate in, are two main things. It's mean reversion to the mean. So if you have this mean and you go above the mean, then you have a tendency to go down to the mean. Or if you undershoot and go under the mean, you have a tendency to rise and go back to the mean. So I'm a big fan of mean reversion. And I can't get into that right now, especially how that works in commodity markets with oversupply, undersupply, overinvestment, and underinvestment, and how those things are cyclical. We've talked about it before, but that's one of my main theses. My other one is time arbitrage. I'm not running a pension fund. I'm not running a hedge fund. I'm not private equity. I don't have limited partners I have to report to that are calling me and threatening to sue me or withdraw their money. I'm just me. I can wait 2-3 years. I have that ability to outwait and wait through till things revert to the mean, where most people can't. If you were running a hedge fund and you were long oil and you bought into the thesis of the underinvestment, you had to liquidate when things were going down, because if you don't, you're going to get thrown out of a job. They're going to say, look, you just lost us 30 or 40% of our money. What? Well, you got, and then you go to the limited partners and tell them, well, you got to think long. That's not how people think. Even some of these people with big money, they don't think that way. Give me my money back. Step into my office. You're freaking fired. That's how it works. So I made a video about that last year. I mean, about how we have an advantage over these people. So yes, I don't like to take losses. I'm down a lot on some of my oil stocks. My conviction's not changed about the underinvestment, the hundreds of billions of dollars that have not been invested in new production. And I know what's going to happen. It's without a doubt. U.S. shale, the Permian Basin is not going to be able to double production in the next year or two. I mean, we're at 12 million barrels a day out there, 11 million, whatever it is, 11 to 12 million barrels a day. You've got these huge depletion rates going on, so that has to be overcome. Plus, you have to drill more wells to actually increase production. It's the law of large numbers at some point. And I think there's this, people don't understand the math. They don't understand what's really going on. And they just make, these wild statements. Matter of fact, like most people don't realize 30% of the oil comes from offshore. Okay, so what? We don't need that anymore? We're not going to invest any more offshore oil? No big projects are being sanctioned or put in, these are long lead time things that need to be invested in order to replace current production and reserves. And it's not happening. So, I point out some things here. You've got energy sector has fallen to multi-year low weightings in all major indices. That means no one cares. Generalist investors don't care, but yet energy underpins every single activity, human activity, agriculture, transportation, goods production, plastics, fertilizers, anything. And people just like, oh, well, we don't need oil anymore. Oil demand's going away. It's bullshit. People just don't understand. They don't understand the math. That's why I'm so adamant about understanding and investing in the energy markets when they provide opportunity. They are underpinning every human activity. It enables human civilization. Otherwise, we'd be living in huts, scratching out, a living in the dirt. So I think, we had these sharp liquidations in some of these funds and that were long oil and short natural gas. The algos jumped in, AI, there's people that trade on the downside too. And so something's, it's momentum, people are going to pile on. We've got many oil stocks now down by 50% or more, and they're trading at levels they were last trading at when oil was like $26 a barrel back in, 2015, when OPEC tried to drive the shale business out of business. We've got the most oversold levels in energy stocks since the financial crisis. It's just, it's crazy. Here's something from Sediment Trader. I follow them on Twitter. They had a tweet the other day, but, in the past 28 years, that's a generation, guys, there have been 2 times when every stock in the S&P 500 energy sector was below their 10, 50, and 200-a-day average, and more than half were trading at 52-year lows during the depths of the 2008 financial crisis and now. So are you telling me that in the last 3 months, everybody just woke up in the financial markets and in Wall Street and CNBC and all these places, and they've crystal balled this thing, and so they've sold off energy stocks because they're anticipating a 2008 great financial crisis? Bullshit. It's not. It's oversold, guys. These guys aren't that smart. Here's an interesting graphic. So this shows the quarterly returns for the XOP, which is the broad energy index, if you will. And it's been, like I said, put together since the third quarter of 2006. The quarter 4 of 2018 was the worst single quarter in the history of this index going back to its inception. That you can see over here, 36.68%. We were down in Q4 of this year. Go over here to 2008. In the worst of the GFC, we were down 36% in quarter 3 and 33%. Look at 2015, the year that was the worst when OPEC was trying to drive the shale business out. We were still, the XOP was only down, not even 30%. We're down 36.68%, and this is on fundamentals. The fundamentals are this bad that we're sold off the worst in the history. I don't buy it. I don't buy it, and they shouldn't be selling it, but they are. I'm going to go back to my old charts. We went over this before. You got to go back. You got to go back to your research. What's reality? What's perception? What's the difference? Can we arbitrage that? Oil demand, here we are again. It's pretty steady. It goes up between 1 and 1.5 million barrels a day every year without change. And why is that? Because we have several billion people that are moving towards or entering the middle class. When you enter the middle class, you do things like you buy cars, you get a decent house that you put things in it that are made out of petroleum derivatives, i.e. plastics. You start taking trips on airplanes. You have leisure activities that cost more energy. So as we see in emerging middle class, specifically in Asia, where we have 1.5 billion people urbanizing and doing that in China and in India, it's inevitable that oil demand is going to increase. Now, this is big picture. This is what's going to affect things over a decade or 2 decades, not 2 weeks or 2 quarters. And this is why I'm going back to my research and why I'm still bullish and why I look at this recent decline as a gift horse in the mouth. Investment's still lagging, guys. We've seen oil company after oil company now slashing or reducing investment in new drilling and new production. That's not going to help. We've got increased demand of 1 million to 1.5 million barrels a day, and we have depletion of 4, 5, or 6% a year overall. That means you got to go out and find anywhere from 5 to 7 million barrels of new and put it online every year. That's the equivalent of bringing a new Iraq on, or new, every year. So that's not happening. And at some point, it's a problem. Here's our benchmark that we like to look at. Our favorite offshore driller, Ensco. I mean, look at this thing. Around Halloween, the thing was trading over $9 a share, and in the space of less than 90 days, it's at $3.37. I mean, it's basically being priced for bankruptcy at this point. And it could go bankrupt. I don't know. I mean, I'm not a soothsayer. But I do know that we still get 30% of our oil production from offshore oil. I don't think that's going away. Couple that with underinvestment. We get through this, squishy period where we have all these different informational things happening, and the market's temporarily oversupplied because of the Trump double cross and the overproduction by OPEC because of Iran sanctions, plus all the other sediment and perception things, negative perception that's been piled on. We got to get through this and see what the real oil price is, because it's not $45 a barrel WTI. I can tell you that. I'm looking at some things here. I'll give you an example. I'm not recommending this, but this is a company that I've owned. This is Vermilion Energy. This is a big, large Canadian oil company that has assets all over the world. They're very diversified. They're very well managed. They hedge their production. They buy and develop things when they're cheap. And you should take a look at their website. I've owned this stock off and on over the years, but right now, at its current price at around $21 a share, this company's dividend is almost 10%. And at current oil prices, the dividend is safe. They are able to cash flow enough at this oil price level that the dividend is safe. I mean, would you want to go short this stock at $21, or does it look like maybe we're at the bottom and this stock maybe moves higher with a 10% dividend? Now, granted, if you think oil's going to $30 or $25 a barrel or $20 and it's going to stay there, then you don't buy oil stocks. I just don't see at 100 million barrels of day demand worldwide and growing, plus depletion and underinvestment, how the oil price can stay down at $45 a barrel. Remember something, when something that's in demand like oil decreases in price like it has, the demand for it goes up, not down. It's not going away in the next, year or 2 or 3. I guess down the line, 2030, 2040, 2050, yes, there'll be more electric cars. I don't know how that's all going to shake out, but that's irrelevant for what we're talking about over the next year to 18 months. And this is a diamond in the rough. You get a 10% dividend. It's a well-managed company. They've got assets spread out. They natural gas production that they feed into the European market, offshore Ireland. I mean, they've got oil, long life, low decline, cheap oil onshore Europe production. I mean, this is a good company, and it's way oversold. There's dozens. I can find dozens of companies like this. I can put together a portfolio of Canadian oil companies that are well managed and are cash flowing nicely even at these oil prices. They're going to pay me 8 to 9%. I can put a dividend portfolio together of 8 or 9%, and companies that will probably have appreciation upward potential of 50 to 100% over the next 12 to 18 months if the oil price recovers to, let's say, the low 60s. It's just how it is. So I think that we need to really look at things how they are. It's emotional. It gets scary. But like I said, if you have conviction and you believe in your thesis and you understand, you know, if something changes, then okay, well, you know, then you have to change your views. But I don't think anything changes except that we had some extraordinary influences in the market which are not long-term fundamentals of these markets. That's my view. So I hope I laid the case out for you. I'm going to be buying some of these stocks, you know, and I see it in my newsletter subscriptions. Subscriptions are way down because no one is going to listen to me. I mean, to many people, some people listening to this, and I want to hear it in the comments. You know, what am I? I might sound like a lunatic to some of these people. Is this guy off his nut? Did he fall off a ladder on his head? I mean, he's still buying these stocks. Yes, I am. I was bullish on the fundamentals when the oil price was substantially higher, and now I'm even more bullish. And this is how real wealth is created, guys. So that's my view. You can think that I'm, you know, running around naked in the neighborhood screaming at full moons, but this is, I think I can lay the case out, and I think I have. And that's where I'm at. So that's it for this week. Probably won't talk to anybody until after Christmas. So if I don't put another video out before then, Merry Christmas to all the listeners. Happy holidays. Hope that you can, you know, take a step back from these crazy markets and spend some time with family and friends, charge up, because we're going to have a very exciting year next year, I think, for some of the things that we're tracking. So we started this thing in early 2018. It's really been going fairly well. It's been growing nicely. We've met a lot of really great and generous people that have, you know, from all walks of life and all backgrounds. Appreciate the support. And we look forward to a very happy and prosperous 2019. We'll talk to you next week, guys. Thanks.